While America slept, China made a move so precise, so calculated, that by the time Wall Street opens its eyes tomorrow morning, the damage will already be done. One public threat, one exposed weakness, one open door. And Beijing walked straight through it, not with missiles, not with sanctions, but with something far more dangerous, something the mainstream media will never show you. What happened tonight could change everything you thought you knew about who actually controls the financial future of this world. Welcome to our YouTube channel. Now listen, if you are the kind of person who has lived long enough to know that history always repeats itself, the kind of person who remembers when they said the dollar was untouchable, when they said America could never lose its grip, then this channel was built for you. We don't do noise here. We don't do headlines. We connect the dots that the suits on television are paid not to connect. So do yourself a favor. Hit that subscribe button the same way you'd lock your front door at night. Quietly, carefully, and without hesitation. Because the information coming in this video is not something you want to miss ever again. And before we go any further, drop a comment right now. Where in the world are you watching this from tonight? Because this story is affecting every city, every market, every pocket, from New York to Karachi to Shanghai. Let us know you're here. And then, let's begin. It is 11:37 p.m. on the east coast of the United States. Most Americans are asleep. Their phones are charging on their nightstands. Their televisions are off. Their children are in bed. But somewhere in the glass towers of Wall Street, the lights are still on. And the people sitting behind those screens are not sleeping. They are working. And what they did on this particular Monday was not business as usual. What they did was a crime. It started quietly, the way most financial crimes do. When the opening bell rang at 9:30 a.m. on Monday morning, silver was trading at a price that was beginning to make certain very powerful people very uncomfortable. Bond traders, the men and women who monitor inflation like doctors monitor a patient's pulse, were starting to see something in the numbers that frightened them. Inflation was rising, the signal was getting louder, and silver was telling the truth. Because that is what silver does. It has always done this. For centuries, when governments print too much money, when debt climbs too high, when the financial system starts to crack at its foundation, silver rises. It is nature's lie detector for the global economy. And on Monday morning, it was screaming, so they had to silence it. From the opening bell at 9:30 a.m. to the closing cross at 4 p.m. Eastern, Wall Street spent every single hour of that trading day pushing silver down, artificially, mechanically, deliberately. By the time the closing bell rang, silver had been crushed down to $29.37 per ounce. The inflation signal was suppressed. The bond traders could breathe again. The screens showed calm, but the calm was manufactured. And the cost of manufacturing it was enormous. To suppress silver, they needed a distraction, something big enough to flood the market with supply and pull attention away from what was really happening. So they opened the Emergency Strategic Petroleum Reserve. They dumped 86 million barrels of oil onto the market in a single session. Think about what that means. The Strategic Petroleum Reserve exists for one reason: national emergencies, wars, natural disasters, supply chain collapse. It is not a trading tool. It is not a pressure valve for Wall Street's uncomfortable afternoons. But on Monday, that is exactly how it was used. The oil flooded the market, prices dropped, the inflation signal quieted, and silver fell exactly where they needed it to fall. Mission accomplished, or so they thought. But here's what the people behind those screens did not fully calculate. Every action in a global financial system produces a reaction somewhere else. When you push silver down artificially, you do not make silver less valuable. You simply make it cheaper. And when you make something cheaper, someone is going to buy it. Not the small investor, not the retail trader watching charts on his laptop, someone with deeper pockets, someone with a longer plan, someone who has been watching Wall Street's moves for decades and has learned exactly how to use them against the people who make them. On the other side of the world, in a city that never truly sleeps either, Shanghai was watching. The Shanghai Gold Exchange, which operates outside the reach of Western regulators, outside the visibility of Western algorithms, outside the headlines of Bloomberg and CNBC, was already preparing. Because the moment silver hit $29.37, it became the most valuable discount in the global commodities market, and someone was about to take full advantage of it. This is where the surface level crime ends, and where the real story begins. Because what Wall Street did on Monday was not just a financial maneuver, it was an accidental invitation. And by 11:37 p.m. that same night, Beijing had already walked through the door. The question is not whether this happened. The question is, why did the most powerful financial system in the world hand its greatest rival the perfect weapon, and who gave them permission to pull the trigger? There is a rule that every experienced chess player knows. Never show your opponent which piece you are afraid to lose, because the moment you do, they will go straight for it. On the same Monday that Wall Street was quietly suffocating the silver market, something else was happening, something far more visible, far more public, and far more damaging. The President of the United States went on live television, and he made a threat, not behind closed doors, not through diplomatic back channels, not in a classified briefing room where only the right people could hear it. He made it on camera, in front of the entire world. The target of that threat was President Xi Jinping of China. The message was simple, almost shockingly simple for something with such enormous consequences. The United States would delay its upcoming diplomatic summit with China, unless Beijing agreed to send Chinese naval warships to the Middle East, specifically to the Strait of Hormuz, to help secure global oil supply routes. Read that again. The President of the United States was asking China to help protect the world's oil. Now, on the surface, this might sound like bold leadership, strong negotiation. America playing hardball. But serious analysts, the ones who study power, not politics, heard something very different. They heard a confession. Because when a nation publicly demands that its greatest rival send warships to protect a critical oil waterway, what that nation is really saying is this: we can no longer protect it ourselves. The Strait of Hormuz is not just a shipping lane. It is the single most important choke point in the entire global oil system. Nearly 20% of the world's oil supply passes through that narrow corridor every single day. Saudi oil, Iraqi oil, Kuwaiti oil, UAE oil, all of it moving through a channel barely 33 kilometers wide at its narrowest point. For decades, the United States Navy stood guard over that strait. Not because America was generous, not because America was the world's policeman out of the goodness of its heart, but because the dollar depends on it. The entire architecture of the US dollar as the world's reserve currency was built on one foundation: American military control over global energy supply routes. Remove that control, and the foundation begins to crack. And on Monday, the president told the world that the foundation was cracking. He did not use those words, of course. Politicians rarely say what they mean directly, but the message was heard by every finance ministry, every central bank, every sovereign wealth fund on the planet. The translation was clean and brutal. America needs help. Beijing received that message at the highest levels of government. And they did not panic. They did not call an emergency meeting. They did not issue a formal protest. They smiled, because this was not a surprise to them. They had been watching this moment approach for years. They had studied the overextension of American military commitments. They had tracked the rising cost of maintaining naval dominance across 5 oceans simultaneously. They had done the math that Washington apparently forgot to do. And now, the President of the United States had done something that no intelligence report, no satellite image, no spy network could have ever delivered to Beijing quite so perfectly. He had confirmed their calculations on live television. In the world of high-level geopolitics, there are mistakes that can be corrected. A bad trade deal can be renegotiated. A failed diplomatic meeting can be rescheduled. A misread ally can be reassured. But there is one category of mistake that cannot be undone: the public exposure of weakness. Once the world sees it, once the markets feel it, once your rivals confirm it with their own ears, it does not disappear, it accelerates. And by the time Monday night arrived, Beijing was not preparing a response to the diplomatic threat. They had already moved past diplomacy entirely. They had opened a different door, a financial door, one that Wall Street had unknowingly unlocked for them just hours earlier. With 86 million barrels of oil and 29.37 silver. The blunder was not just political, it was not just military, it was the moment two separate American mistakes collided into one catastrophic opportunity for the one rival that was patient enough to wait for exactly this. Most people imagine war the same way. Explosions, uniforms, borders crossed by soldiers carrying weapons. They imagine something loud, something visible, something that appears on the front page of every newspaper the morning after it happens. But the most dangerous wars in the modern world make no sound at all. They happen in silence, in the space between one market closing and another market opening. In the hours when the traders of New York and London are at home eating dinner, helping their children with homework, pouring themselves a drink after what they believe was a successful day. In those quiet hours, the real moves are made. And on Monday night, China made theirs. To understand what Beijing did, you first need to understand one simple but powerful idea. When a powerful nation artificially pushes down the price of a precious metal, it does not destroy the value of that metal. It simply puts it on sale. And China has never been too proud to shop at a discount. The moment silver was crushed to $29.37 per ounce by Wall Street's Monday session. A very specific set of instructions moved through very specific channels in Beijing. Not loudly, not publicly, not in a press conference or a government announcement. Quietly, efficiently, the way China has always preferred to conduct its most important business, those instructions led to one destination, the Shanghai Gold Exchange. The Shanghai Gold Exchange is one of the most powerful and least discussed financial institutions on the planet. Western journalists rarely cover it. Western regulators cannot monitor it in real time. Western algorithms are not programmed to track its overnight session movements with the same urgency they apply to New York and London. It operates in a different time zone, under different rules, with different levels of transparency. And that invisibility is precisely its power. What happened in that exchange on Monday night was not random market activity. It was not retail investors chasing a cheap commodity. It was systematic, deliberate, institutional. Chinese buyers, operating through state-connected financial structures, began purchasing physical silver in extraordinary volumes. Not paper contracts, not futures positions that exist only on a screen. Physical silver, real metal, sitting in a vault that has to be moved, shipped, and delivered to wherever the buyer instructs. Every ounce purchased in Shanghai was an ounce that would no longer sit in a vault in New York or London or Zurich. Think of it this way. Imagine a man who owns a shop. One day, in a moment of panic, he drastically slashes the price of his most valuable product just to keep his other products looking stable. And his competitor, who has been watching from across the street for years, walks in, fills his cart, pays the discounted price, and walks out. By the time the shop owner realizes what happened, his most valuable inventory is gone, transferred permanently to the competitor who was patient enough to simply wait for the shop owner to make a mistake. This is exactly what unfolded between Wall Street and Shanghai on Monday night. America created the discount. China consumed it. America built the trap. China walked through it with a shopping cart. And the mechanism that made it all possible was the very suppression tool that Wall Street believed was protecting them. But here is what makes this retaliation particularly significant for serious observers. This was not just about silver. Silver was the vehicle. The destination was something much larger. Every time China converts its US dollar reserves into physical hard assets, it reduces its exposure to the American financial system. It moves wealth out of a currency that Washington controls into a commodity that Washington cannot print, cannot manipulate indefinitely, and cannot recall once it has changed hands. This is the long game. And China has been playing it with extraordinary discipline for over 2 decades. Monday night was not the beginning of this strategy. It was simply the latest chapter. But it was a chapter written with unusual clarity, because this time, America handed China both the pen and the paper. The Western financial media will wake up Tuesday morning and discuss silver's price movement in terms of technical resistance, risk-off sentiment, profit-taking. They will use clean, comfortable language that explains nothing and reveals even less. They will not mention the oil dump. They will not mention the Hormuz ultimatum. They will not connect what happened in Washington on Monday afternoon to what happened in Shanghai on Monday night. Because connecting those dots would require admitting something deeply uncomfortable. That while America was performing strength, China was quietly and methodically extracting wealth from the very system America built to protect itself. The retaliation was not coming. It was not being planned. It was not being threatened. It was already done, executed in silence, settled before sunrise, and recorded permanently in the ledgers of a financial institution that Western regulators cannot even read in real time. There is a moment in the decline of every great financial empire that historians later identify as the turning point, not the collapse itself, not the moment the currency fails, not the day the markets panic and the headlines scream crisis, but the quieter moment, the earlier moment, the moment when the system's most powerful defenders made a decision so strategically flawed that everything which followed was simply inevitable. Future historians studying the slow erosion of American financial dominance may well point to Monday, March 17th, 2026, not because one day destroyed an empire. Empires do not fall in one day, but because on this particular Monday, two separate American failures arrived at the same moment, pointed in the same direction, and handed the same rival a weapon it did not even have to build. Let us be precise about what actually happened. The United States Federal Reserve and its affiliated institutional networks on Wall Street spent an entire trading session suppressing the price of silver through coordinated selling pressure. They deployed emergency oil reserves, reserves that exist for genuine national crises, as a commodity market manipulation tool to temporarily silence an inflation signal that was frightening bond markets. This is not conspiracy. This is mechanics. This is how the system manages itself when it feels threatened. But managing a symptom is not the same as curing a disease. At the exact same time, the executive leadership of the United States made a public diplomatic demand of China that inadvertently confirmed what Beijing's analysts had been calculating for years. That American naval dominance over critical global oil infrastructure was no longer absolute. That the military foundation beneath the dollar reserve system was developing visible cracks. These two events, the silver suppression and the Hormuz ultimatum, were not coordinated. That is precisely the problem. The right hand did not know what the left hand was doing. And in geopolitical competition at the highest level, that kind of institutional disconnection is not just embarrassing, it is catastrophic. For the business community watching this, for the entrepreneurs building companies, for the investors allocating capital in this environment, the lesson here is not abstract. It is immediate. It is practical. And it applies directly to the decisions being made in boardrooms and trading desks right now. When the reserve currency of the world begins showing structural vulnerability, when the military power that underwrites that currency's global dominance begins publicly acknowledging its limitations, when the primary rival to that system begins systematically converting dollar-denominated reserves into physical hard assets at an accelerating pace. These are not background events. These are the conditions of the market every serious decision maker must now factor into their strategy. Bloomberg will not say this. CNBC will not frame it this way. The financial press that depends on advertiser relationships with the very institutions executing these maneuvers will offer explanations that are technically accurate but strategically incomplete. They will tell you what moved. They will not tell you why. They will describe the surface. They will never describe the architecture beneath it. That is not incompetence. That is a business model. But for those willing to look clearly at what Monday night revealed, the picture is not complicated. A great financial system, under internal pressure, made a short-term defensive move that created a long-term strategic opening. A disciplined rival with a multi-decade plan recognized that opening immediately and moved through it with the kind of calm institutional precision that only comes from having prepared for exactly this moment long in advance. This is not new behavior from China. They purchased gold aggressively when Western banks were selling it. They built alternative payment systems when Western sanctions were being weaponized. They established the Shanghai Gold Exchange when they understood that the London and New York pricing mechanisms would eventually be used against them. Every move was preparation. Every preparation was patience. Every patient decision was pointed at this exact moment. The dollar system is not collapsing tonight. Let that be stated clearly and without exaggeration. But systems do not collapse overnight. They erode. They weaken at the edges before they fracture at the center. They send signals that serious observers recognize early, while the majority remains comfortable in the assumption that what has always been or will always continue to be. History has never once honored that assumption. The Roman denarius was not debased in a single afternoon. The British pound did not lose its reserve status in a single decade. These were long processes, marked by specific moments, accelerated by specific decisions. Decisions made by people who believed their system was too large, too powerful, too deeply embedded in the global order to be seriously threatened. Monday, March 17th, 2026 was one of those specific moments. Not the end, but a chapter in a story whose final pages are being written right now in Shanghai, in silence, while the West sleeps. The wealth of nations has always moved. It has never asked permission. It has never announced its departure. It has simply followed the decisions of those who understood the game and the mistakes of those who forgot they were playing it.